When the Fed first lowered interest rates down to zero and began its program of quantitative easing, known as QE, at the very beginning, I'm on record as stating that what the Federal Reserve had actually done was check the nation into the equivalent of a monetary roach motel, meaning they could enter the policy, but they could never remove the policy. And eventually, the Fed was able to convince the world, not me, but pretty much everybody else, that it could do just that. That after having kept interest rates at zero for, 7 years or so, and having done 3 rounds of quantitative easing and blown up its balance sheet to $4.5 trillion, the Fed began assuring the markets that it was simply a matter of time, and they would be able to unwind the balance sheet, shrink it back down to the level that it was at prior to the financial crisis, and normalize interest rates. Now, I never believed that that was possible, but the Fed fooled the markets. Now, if you remember, initially, when the Fed first launched quantitative easing, I wasn't the only one that was skeptical. There were a lot of mainstream voices out there that were worried about the path the Fed was taking us down. And in that environment, the price of gold actually got as high as $1,900 an ounce in 2011, and silver got up to $50. That was a level it hadn't hit since the Hunt brothers tried to corner the market back in 1980. But a lot of people don't realize or don't recall that the bull market in gold and silver didn't start with the financial crisis. It started years and years before. As the Federal Reserve was inflating the housing bubble, the cheap money that inflated that bubble also caused smart money to move into gold and silver. So gold started that rise from under $300 an ounce in 2001, and silver was under $4 an ounce. So by the time it hit those peaks, we were at a high point in a major bull market. We then moved into a correction, and what sparked that correction was the false belief that the Fed could actually succeed in unwinding its balance sheet and normalizing interest rates. Now, I knew that they would fail, but again, I was alone, or maybe I had a little bit of company, but not much in the mainstream. And it was against that backdrop where everybody expected more and more rate hikes and quantitative tightening, right, the reverse of quantitative easing. People expected that to continue because the Fed was bluffing that it would continue. The price of gold went all the way back down to $1,050 an ounce. But it never came anywhere near the $200-300 level that it started the bull market at. In fact, it never even went back below 1,000. And when gold bottomed out, coincidentally, it bottomed out on the very day that the Fed finally began to hike interest rates. And of course, all the naysayers were saying that that was going to be the kiss of death for gold, that the minute the Fed started hiking interest rates, gold was really going to go down. Well, the reality was all the rate hikes had actually been factored in. And so by the time the Fed got around to delivering a rate hike, gold actually bought the rumor. But the problem is there was rumors of a lot more hikes than the Fed was actually able to deliver, which is why the price of gold rose about 50%. It's gone as high as $1,550 since, as I'm recording this, the price of gold is just about $1,500 an ounce. But what's more interesting, and why I decided to record this video, is that not only did the Federal Reserve just cut interest rates for the second time this week, and again, I believe that when they cut rates for the first time, it was the first step on the road back to zero. But what the Fed has now done is basically launched the equivalent of QE4. Now, they're not officially calling it QE4, but that's basically what it is, because what the Federal Reserve is now doing is expanding its balance sheet, creating money out of thin air to buy government debt and other debt to artificially suppress interest rates. In the latest week, the Fed's balance sheet exploded by more than $75 billion in just 1 week. And even Ben Bernanke, following the rate hike, suggested that the Fed might have to return to balance sheet expansion sooner than thought, which means they're already doing it. In fact, they don't want to call it quantitative easing. And you have to remember why they called it quantitative easing the first time. It was because they didn't want to be honest with the public about what they were doing. You see, quantitative easing is just good old-fashioned debt monetization. That's what banana republics do. America is doing the same thing, except we don't have the bananas. And a lot of people would certainly be concerned if America went down that road. It didn't work well in Argentina. It hasn't worked well anywhere it's been tried, and it's not going to work well here either. So they didn't want to admit that they were monetizing the debt, because after all, what is monetizing the debt? It's taking debt and turning it into money. You're creating money out of thin air. That is inflation. That is the basic definition of inflation, before the government tried to confuse the public into believing that inflation was rising prices. Rising prices result from inflation. Inflation is the expansion of the balance sheet. How does the Fed expand, or rather the expansion of the money supply? How does the Fed expand the money supply? It expands its balance sheet. It does quantitative easing. So quantitative easing is inflation. It is debt monetization. It is a bad thing, but the government, or the Federal Reserve, tried to dress it up as a good thing by calling it quantitative easing. And in fact, even when Ben Bernanke first appeared before Congress, some Republicans had the guts to call him out on monetizing the debt. They accused Ben Bernanke rightly of monetizing the debt, and Ben Bernanke lied through his teeth and said he wasn't monetizing the debt because it was just a temporary measure. They were simply buying bonds temporarily. As soon as the emergency was over, they were going to sell them, and so they really weren't financing the government through monetary policy and through debt monetization. But of course, we know now that was a lie. I knew it was a lie back then. I called out Bernanke when he told that lie. And now, of course, we know that those bonds are still on the balance sheet. But now that the Fed is going to relaunch quantitative easing, exactly as I said they would do when they first began the program, they don't want to call it QE. Initially, they didn't want to call it debt monetization, so they came up with a better way of describing it instead of being honest. But now there's a stigma, because if the Fed has to admit they're going back to quantitative easing, they have to admit the economy's in trouble. But they want to deny that. They want to pretend that everything is great. We just have to go back to the same type of emergency monetary policy we did during a financial crisis and the Great Recession. You see, they want to have their cake and eat it too when it comes to doing QE, but they want to claim that the economy doesn't even need it because it's in great shape, and so whatever they're doing is just a precaution. So now they want to label debt monetization permanent open market operations. And in fact, today we have Federal Reserve officials saying that, hey, this is not quantitative easing. This is just central banking 101. And central banking 101 means basic central banking, textbook central banking. So now, what was once an emergency tool that would be used only in a dire emergency, like the worst financial crisis since the Great Depression, right? The Fed had to reach for this tool in an emergency, right? Now, just as I said, this has now become normal operating procedure, central banking 101. Because as I said from day one, once the Fed took us down this road, there was no going back. Once you hook somebody on drugs, they're hooked for life. They can't kick the habit without going through massive withdrawal, especially when you have as big a habit as we do. So by levering up the nation, by keeping interest rates so low for so long and doing quantitative easing, right, they created a phony economy that is completely dependent on the continuation of those policies. And when they tried to remove those policies, just like I said, as the market started to exhibit some signs of going into a withdrawal, especially when you see what's going on now in the Fed funds market and the emergency liquidity that the Fed had to bring into the market to continue the artificial suppression of interest rates, the illusion, the myth that the Fed created, that there was an end game, that there was an exit strategy, is going to be shattered. And the reason that the price of gold retreated, the excuse that caused that correction, was the wrong-headed belief that the Fed could end quantitative easing and normalize interest rates. When the markets now figure out that QE is infinite, it's permanent, right? That it's never going to end, that interest rates are stuck at zero or lower indefinitely, then the price of gold is going to take off. Because the only reason that it stopped rising back then is because of the false confidence that the central bankers were able to engender. All that confidence is going to be lost. and people are going to be rushing out of fiat money, the dollar in particular, into gold, into silver. Now, eventually, interest rates are going to be forced higher. The Fed is going to have no choice, because if it tries to suppress them indefinitely, we will have hyperinflation. We will completely destroy the value of the dollar. But regardless of whether or not the Fed ultimately makes the right or the wrong choice, before that happens, the price of gold and silver are going much, much higher. If they make the wrong choice, the price will go infinitely higher. Let's hope they don't do that. Let's hope at the end of the day, they eventually do what's right. But because they're going to wait so long to do what's right, it's going to be a lot more painful for everybody else.